Hello everybody. So in today's video I want to talk about two stocks that have crossed my radar today and one that I may consider buying and the other one that I also may consider buying. So first of all, just so you know, if I buy these stocks, that's going to be very tiny positions. These stocks are what I call my he must do something position, because I have a he must do something brain, and my he must do something brain likes to get a good deal. And right now, a lot of my stocks, are up 50, 60, some 80% compared to 2 months ago. That's probably not the best way to look at such a narrow window, but it doesn't feel comfortable to pay 80% more for a stock now compared to what you were paying, just 2 months ago. It doesn't feel as good. So new money, I like to put it in perhaps tiny positions that could be good deals. Now, of course, like I said, it's a tiny portion of a portfolio. My main position is still Tesla, well above 30%. The second one is still Enphase. Bitcoin is still a very large position, right? This is not a meaningful investment in these small caps. All right, enough about that. What do I like about these stocks? Well, if you look at these stocks, they are pretty inexpensive. If you look at Shockwave Medical, the stock is trading at the same level that it was 2.5 years ago, and it's actually dropped quite a bit this year. And if you look at Shoals Technologies, the stock is trading at essentially close to the lowest that it's ever traded. Not quite, but almost, right? It's 20% up from the lowest when it's ever traded. It's way down from IPO, down more than 60% from IPO. So when you look at the chart, first of all, it feels good because you're not overpaying by 80% compared to where it was 2 months ago. Although that's an entirely irrelevant factor. I just want to point that out. I'm perfectly fine buying stocks and paying 80% more now than I was 2 months ago if the stock is undervalued. But there are stocks that are still undervalued, that have not run up. This is the case of these two companies in my view. They're still undervalued and they have not run up. So I'm going to start with Shockwave Medical. Shockwave Medical is cheap at a 0.19 in my spreadsheet. That's in the first quartile of cheap. And Shoals is actually pretty cheap if you compare to the new solar valuation. So, my spreadsheet is very sensitive to revenue growth. And Shoals is actually one of the solar companies that has not experienced a reduction in its growth, mostly because they deal with a very specific part of the equipment for solar. And I'll get into Shoals. So let me get started with Shockwave Medical. So what is Shockwave Medical? Well, it's a company that's awfully specific. It's very specific, but what they do is they're creating this new standard of care that they call it. They're creating this new procedure called IVL, and what it does is it breaks calcium. That's actually the motto of their company. We break calcium is their motto. How fun is that? It breaks calcium in patients' arteries that have calcium deposits, and it's supposed to be a breakthrough compared to all of the other technologies that are out there, which are two main ones, which are pressure balloons and atherectomy, which have all downsides, as they've highlighted, and they have a lot of clinical studies showing that their method is actually about 100% better. It's about twice as good, their method. And what is their method, which they have patented everywhere? And patent doesn't mean you're not going to get copied. Patent just means that you get to go to court if someone copies you. So I just want to be very, very clear about that. I mean, having patents and having something proprietary doesn't mean someone is not going to copy you, right? They could have competition coming from here and there. But nonetheless, what is the technology? It's this device right here, right? And what it does, this device, is you put it in your the doctor puts it in your arteries, and it sends sound waves, and it is the sound waves that break the calcium deposits. The sound waves, as opposed to a pressure balloon or as opposed to this pump type of catheter that you see right here. So kind of a modern take on dealing with heart disease. And And what do we know about this company? Well, like I said, it's a cheap company. Revenue growth is 57% predicted next 12 months, 57%. And gross margin is 87%. And there's a lot of good things going for this company. First of all, the total addressable market is huge. Heart disease is the leading cause of death in most of the Western world, right? And in America, it certainly is the leading cause of death. And so we have an aging population. And so right now, the total addressable market, just for what they've identified as they're, dealing with calcium issues in the arteries, that market is $8.5 billion right now. That's for the world, by the way. And they note in their presentation that this is likely to grow as the population is aging. Obviously, the more people age, the more there's cardiovascular disease. Another big thing going on for this company is the fact that they are developing a similar process for refractory angina, and so they haven't developed it yet. But if they develop it yet, they estimate that this could be multi-billion-dollar total addressable market in addition to the 8.5. So what is it going to be, like 12, 15 once they develop that? If they succeed at developing that, that's always the risk in investing in any medical device type companies. You always have a binary event that can happen. Like their new tech gets approved, that's a binary event, and you get a valuation reset of a company where it's up 50% or something like that. They also have international expansion possible. They're about 60% of the world population covered, right? Mostly Western countries, but they have a lot of other countries to get into. I'm looking at Southeast Asia, for example, which is way underrepresented. Latin America, they still have a way to go. So, anyways, and Africa, of course. But anyways, if you look at this, 60% of the world, they still have quite a bit of growth possible in the rest of the world. So that's also another catalyst of the growth. I don't pretend they're going to get to 80%, to 100%, but could they get to 80%? Probably, right? Probably. And what else is going on? What is an important thing to understand for this company is it's all about reimbursement and whether you can get Medicare and other systems to reimburse you. And so hospital inpatient, hospital outpatient, and ASC, they've got all of the reimbursements effective. And you can see some of them are effective as of October 2023. So that's a big deal each time you get approved for reimbursement. And they are hoping that OBL, that's office, that's kind of light procedures at an office. They're hoping that it's going to be eligible for reimbursement, and then they're also hoping that at the physician's office, at the doctor's office, the product is also going to be able to be used. And the fact that this is approved for reimbursement, this has to do with medical societies validating their results and validating the benefits and validating the 100% better outcome that I was telling you a second ago. And if you look at the financial profile, this is where it gets outstanding to me. It gets outstanding. Why? Because you can see they doubled revenue in 2022 compared to 2021. And right now they're at 671 million. So who knows, are they going to be at 800 million? 8 to 900 million when they report Q4 for the full year 2023. So that would put us right here. And then we're predicted to go on top of that another 57%. So, 57%, you get somewhat of a lot of large numbers, but it's realistic to imagine that over the next 3 years, this is a company that's going to be at around 50% revenue growth, which makes it so cheap over multiple years. So I like this company very much. I think it's a very interesting play, and I've covered medical devices before on this channel, and what I like about this one is, it's a US-based company. It's based on an actual need, which is heart disease. It's not based on, say, liposuction, for example, like what's the name of that Israeli company that does aesthetic procedures? I can't remember it. InMode. Like, it's not like InMode. It's not discretionary. This is a must-have. It's somewhat recession-proof because it's Medicare that's paying for it, or reimbursement, or your insurance that's paying for it. It's got tailwinds of a population going for it, right? The population's aging around the world, and so this is going to be needed. And it's dirt cheap. and it's very cheap. So I'm very pleased with this company, and it's highly efficient. They only have something like less than $400 operational employees out of 1,400 employees. The rest of our employees are all about sales. So it's a very efficient company, and the gross margin is outstanding at 87%. So I'm willing to take a little risk and start a tiny position on this one. All right, what's the other company that I like that I want to cover today? It's Shoals. I've briefly covered Shoals in one of my solar review videos, but this time Shoals is getting cheap. Shoals is actually getting pretty cheap now. So what does Shoals do briefly? What they do is they focus on these connectors and combiner boxes for large utility scale installs of solar. So they only sell the connectors, which is why you can see they're going to be less impacted by, say, distributors and demand from residential. They're just dealing with the connectors. They're selling the picks and shovels of solar. This is a company that is cheap for solar. As I showed you, let me show you again, compared to Enphase at a 0.91, 0.37 is actually pretty cheap, but it's interesting that I'm using 34% gross margin here, and when you look at their adjusted gross margin, they're reporting a 47% in Q3. So I do not know what's wrong with Seeking Alpha putting 34%. I would have to dig a little more into these numbers, but my guess is that that's an outdated number, and the gross margin is actually much higher than that even today, which would make this price even more attractive. Anyways, what I love about Shoals is when you look at these charts right here, it's just up. Everything's going up, right? Revenue is going up. It's a profitable company. It's a company that has a PE. They have adjusted EBITDA. They have net income of $114 million. Gross profits going up. Everything's going up. And if you look at the predicted growth, so the analysts are telling us that there's going to be 45% forward growth for this company. But if I do what I like to do, which is taking the quarter-over-quarter rate and annualizing it, so they're guiding for Q4. We're in Q3 now. They reported Q3. For Q4, they're guiding $495 million. I'm taking the middle point. So $495 million in revenue for Q4. You know, mind how cheap that is. Like, think about that. Calculate how cheap that is. That is pretty darn cheap. So about $500 million bucks, right, for a $2.5 billion company. Quarter-over-quarter growth between Q3 and the Q4 that has been guided. That's 9.2%. And if you annualize that, you're at a 42% annualized. Analysts are predicting 45%. So this is a company which, again, is going to grow at above 30% for probably many years to come. And what I like very much about it is when you look at the stock price since IPO, it's down 60%, right? But revenue since IPO is up, about 150%. Yeah, if you're going to count Q4, you're going to have revenue that's up about 150 to maybe add a few quarters 200%. So plus 150 to 200% in revenue. Stock price is down 60%. Riddle me this. The market is irrational. This is yet one of these companies that's being sold off. And I like, of course, that it's in the field of solar. As you know, I'm a big believer in solar energy. I want exposure to this field, and I like that it's in this field very much. So anyways, this was not investment advice. This is just entertainment. I hope you were entertained. Please like, please subscribe, and have a wonderful day. Thanks for watching.